In this episode, we're going to discuss the working capital purchase price adjustment and why in a lot of buy-sell transactions you see this verbiage and calculation embedded into a transaction. So in this episode, we're going to discuss what is working capital, how to calculate it, and how the purchase price adjustment actually works, as well as some takeaways for both the buyer and seller. So if you're considering selling a company or purchasing a company, then stick around because this video is for you. As always, as we go through this presentation, if you've got questions, please either email me or just simply drop a comment in the section below and I'll get back to you as soon as I can. In addition, if you find this video helpful, please feel free to hit the like and subscribe button. And with that, let's talk about working capital. So working capital is really the difference between a company's current assets, which could include cash, accounts receivable, inventory, and the positive side of a WIP or work in process, minus a company's short-term liabilities, which could be accounts payable, credit cards tied to production, and the other side of the WIP, which is the work in process. Now, for a company to have a healthy working capital, that ratio should be around about 1.5 to 2.0, depending on the operations of the company and cash required. So the working capital on a positive basis should be what feeds the company on an ongoing basis. So if you're a buyer buying a company, you need to make sure that in addition to the purchase price that you put forward, that you have ample working capital. Now, if you're a seller selling, you want to make sure that you understand the working capital requirements for your company and what should probably be left in. And if you've got excess working capital, you should take it out. So let's take a look at an example. Let's use the following as an example. Now in this balance sheet calculation, we've got current assets of cash of $1,400,000, accounts receivable of $7,600,000, and costs in excess of billing, or the positive side of the WIP, of $420,000, giving you a total of $9,420,000 for current assets. Now let's take away the current liabilities or short-term liabilities involved with the business. Accounts payable 2.6 and billings in excess of costs of $1,750,000, giving you a total of $4,350,000. The net working capital for this business was $5,070,000, and it had a working capital ratio of 2.17 to 1, which means it had for every dollar of liability, it had $2.17 in current assets. And it's a very healthy number. Now, I actually went back and ran an 18 to 24 month average of the working capital to account for seasonability in this transaction. And we came out to a negotiated 1.80 to 1 on a working capital ratio when we closed. So why is working capital and a working capital purchase price adjustment so important for an ongoing business? Well, simply put, if you don't have enough working capital in the business will cease to operate. Having a positive working capital ratio of about 1.5 to 1.7 really shows a healthy company that's paying its ongoing bills, has enough to reinvest in growth, and will just simply not rely on any outside debt to keep the company afloat. Now, if you're a seller, understanding the 12 to 18 month history on your working capital, which can be calculated on a monthly basis and then averaged out to take out kind of seasonality if your revenue's fairly steady, is something that you should understand. And if you're going to go to market, it's something that a good broker or merger and acquisition advisor is going to calculate and represent in that offering memorandum. Now, as a seller, you also need to understand that if you're going to go to market and you have excess working capital, let's say you've got a ratio of 3 to 1, you'd want to take out some of that capital out of the business. Consider lending it back to yourself as a line of credit so that that cash is protected and only used when you need it. If you don't, this buyer may try and negotiate you to leave that capital in it. Now, as a buyer, the same reasons that I just talked about, you need to understand what the actual requirements are for working capital. Because if you don't, and you purchase a business with insufficient working capital, you're going to end up injecting cash on top of your purchase price to satisfy that requirement and keep the business running. So what kind of businesses require working capital? Well, in general, manufacturing, construction, retail companies that have a significant amount of inventories and usually have revenues of, say, in excess of 1.5 million. So things that you might want to take a look at on a balance sheet to look for are bill of materials, work in process, and large inventories. If you've got those kind of components, you want to take a look at what the working capital ratios are for that particular business. Let's take a look at what a deal structure might look like when involving a working capital purchase price adjustment. Now, in this example, we have a purchase price of $20 million, down payment of $2 million, bank financing of $16 million, and a seller note for $2 million, giving you a total of, again, $20 million for the purchase price. Using the previous example of the working capital calculations of a net working capital of $5,070,000 and a working capital ratio of 2.17 to 1, let's take a look at how a letter of intent might be worded and how the working capital purchase price adjustment would actually be applied. In this example, you've got the buyer purchasing 100% of the tangible and intangible assets of the corporation. And the buyer is going to assume the balance sheet at closing with two exceptions. The first one is that the seller will pay off all the long-term debt of the company and that a working capital target will be $5 million. So what happens if you've got more? So when you go to closing, the balance sheet has a net working capital of, say, $5,100,000. Well, simply at closing, the seller would then retain an additional $100,000 of cash to achieve that net working capital target of $5 million. If at closing, on the other hand, they're short, let's say the net working capital comes in at $4,900,000. Well, the buyer would then reduce the seller note. Remember, we had a seller note of $2 million by that $100,000 or on a dollar for dollar basis, thus having accomplished that net purchase price adjustment. So that's how a working capital purchase price adjustment works in 90% of the cases that I'm involved with. Working capital purchase price adjustment. It's not that hard to understand, but if you've never seen it, it can be a little confusing and really just everything's on the company's balance sheet. A couple of key takeaways for sellers. Please make sure you understand what your working capital, your average working capital is for the last 12 to 24 months when you're thinking about going to market. And then remove any excess working capital from the company. And again, you can take that capital, out of the business, especially if you've got retained earnings. There's no tax consequences for it. And then simply lend it back to the company from, just say, a separate entity, and make sure that you file a UCC filing on that capital to protect yourself from any other debtors or liabilities the company may have in the future. And then position a working capital purchase price adjustment or the working capital calculations in the offering memorandum. So a good broker or an M&A advisor is going to run these calculations, advise you to take that capital out of the business if you've got excess working capital, and then recast the balance sheet in that offering memorandum to present a positive picture on, say, a 1.5 or a 1.7 to 1 as far as a working capital ratio. And then you've done your job. Buyers, pretty much the same thing. Understand the company that you're looking at, what their average 12 to 24 month working capital is. And for me, if I'm advising a buyer, I'd be taking a look at the ratio, because a target working capital calculation based on a target dollar amount can, if the company's growing or if you've got declining sales, not be really the appropriate number. So look at a working capital ratio is how you want to structure the purchase price adjustment. So with that, I hope you guys got something out of this video. And if you did, please hit the like and subscribe button, and we'll see you on the next episode.